Good morning, everyone. Welcome to another live webinar here at MarketMinds Mastery. I hope you are doing well. So, Euro US dollar, what happened yesterday? Yesterday, the European Central Bank reported interest rates, and of course, we didn't expect anything crazy to happen in terms of their decision, because it was obvious that they will keep the rates unchanged. So today, let me just fix this one. So after the event, the market, as you see here, created this bearish engulfing. It engulfs the body only. It doesn't engulf the high to the low, but for some of you, you consider this as a bearish engulfing. So let it be. I got a losing trade here 2 days ago because I had a stop loss above there. I entered with a limit order after this bearish engulfing formed, with a limit order to go short from this point with a stop loss above the high of this bearish engulfing. But 2 days ago, the market created this upward move. We didn't expect, actually, after a bearish engulfing from resistance, we don't expect the market to retrace 100%. So that was a very high probability trade. It was with the daily downtrend. Daily is down below the 20 period, consolidated here, didn't break the high of the bullish Morobozu, and it broke the low, closed lower. So we had to take this trade. Now, this one here shaked us out. I didn't find any other setup to take after this one. That's not a shooting star because it comes from the consolidation of this price. A shooting star is a reversal pattern that looks very similar, even though the same, with this one, but we find it after white candles, after bullish candles, after an uptrend. So for today, what do we expect to see on the euro? Definitely, we expect to see a continuation to the downside. I marked you here these support zones, so you can copy them on your chart. And we trade accordingly on the lower time frames. For example, here is a 30-minute chart. If the price breaks below and stays below here, the next area of support is going to be down there. So therefore, you can trade from the S1 to the S2. Next on the list, the pound is still moving sideways, going nowhere. Again, rejection at this point here. So if some people want to position their trading and start looking for short positions, if they believe the market will decline. However, you have to accept whatever comes with a ranging market, with a sideways market. Actually, that's not even a defined ranging market. Price may gonna stay for a while before it breaks, or maybe it's gonna break, who knows. Whatever the price will do, we have to accept it if we decide to get into this trade in the anticipation of a downtrend. But there are also fees and swaps involved as well. And if some of you are trading with prop firm accounts, They are fees, they are swaps, and they are a little bit chilly. So be mindful the style of trading you are, the style you trade depends on also on the conditions, on the account conditions that you trade, on your broker conditions. Okay, it's not only the market conditions, it's also to understand from your broker side how to manage your trades. Any questions? Next one, USD Canadian dollar. We were looking to trade short from here. We took some trades up there. Now the market on the lower time frame, on the 30-minute chart, it tried to approach this monthly resistance, but it didn't manage to tap into this. And this uptrend here ended up as a downtrend. Therefore, now the market declines. USD JPY, if you prefer to stay on the lower time frame, but if you're gonna trade, you're gonna look the 30-minute chart to trade, please try to grab your levels from the higher time frame. Ideally, the daily chart is preferable rather than the 4-hour chart to grab the levels. You can use, I can teach you some basics here. So you want to find the support and resistance. If you're going to trade intraday, you use the previous day high and the previous day low as your first support and resistance. And you can go to the 30-minute time frame, for example. So we know that we are looking for data from this point onwards. So here is the beginning of the day. If you use some kind of volume profiles, now I do not trade the volume as a standalone. I just use it on a 30-minute time frame only, and it's the free indicator. I think that's a volume profile free indicator from the trading view. Now the market, it's at an area of a significant activity. You can see the volume exceeded all the previous lines. So at this point here, there is a vast interest by traders to take positions. So what's the plan if we want to trade the USD CHF? If we believe that based on the daily chart the market will move upwards, then either we wait for a break. I would rather wait for a break, of course, above this 0.86822, a close above it, and then if the price moves away from this area, it will show the significant, it will reveal how important this area is, and then I will place a limit order to get filled within this pullback with a stop loss below these lows here. Conversely, if you believe that the price will decline and you see a false breakout here, then definitely we will go for short, and the room of opportunity, it's going to be this low there around 0.866. Do you guys prefer to see the analysis on lower time frames, or are you happy with the daily chart? On the daily chart, USD JPY price decline from this monthly resistance. It's not that clear. The fact that the price still traded within the yesterday's highs and low, it's something that I personally like it. That's the high, the low, and the price is still within the yesterday's highs and low, because if it's going to break to the upside, maybe we're going to see a strong breakout. But this is how I will trade today. And if you want, write this on your notes. If the price is going to make a higher than the previous day's high, I will place a sell stop order, pending order, to trade short below the low of this one, because it's going to be the potential bearish engulfing candle, and because the range of the yesterday's price is small, it's narrow compared to the ATR. The ATR has 120 or 130 pips, and the yesterday's candle range, it's only 80 pips. So this is a lucrative opportunity, but it's on the daily chart. I don't mind, because it has if it's going to move 130 pips today and my expectations will be correct, then I might get into a trade for 2-1 or 3-1, regardless, within a couple of days. And regardless, it's on a daily chart. That doesn't matter. I often see traders, or when I coach traders, but daily chart is too slow, or it's like this. Guys, especially if you're a new trader, or even if you're trading for a while, the daily chart, it's it's the point you start learning how to trade. Why? Because it gives you the time to understand how the market moves. It gives you the time to understand the swings of the market, the price action. And then, because the data changes every 24 hours, it's easier to look at the same chart 2, 3, 4, 5 times through a day, and then you will see things that you couldn't see the day before. When you trade on the lower time frames, every minute, every 30 minutes, every hour, the price changes, the price action changes, the zones change, penetration of a support or resistance, it create a new market structure. And it's, especially for new traders, it's a bit hard to understand how the market operates, and they just go through trading for years and years, and they experience frustration. They start blaming strategies. They start blaming everything else except the way they learn how to trade. And that's crucial for somebody that's a new trader. For me, when I start trading on the daily chart, it took me some time, but I could start reading the market and understand the market so good, and much better than most of the traders. We start learning together, and they were start trading the 30-minute chart, the 5-minute chart, because we had back then some strategies we were following, and they were experienced frustration all the way. And some of them, and most of them, they are not even trading today. It's been 12 years. Maybe with the people I start, we took some trading education back then at the same place. Maybe I'm the only one that's still in the field now, because once you are excited, you get enthusiastic, you start trading, you go to the 30-minute chart or to the 5-minute, 15-minute chart, because there are more opportunities. Let's go to the 15-minute chart. There are more opportunities here. Yeah, the price, some traders now, they define, okay, that's a resistance and that's a support. So, okay, I could have trade this one. Okay, I will go short from this one. That's an opportunity. Go short. The price bump goes upwards. Why? Because that's a resistance, but that's not the support. The market is not in a range. The daily chart showed something else, where the market force, they don't know how to read this data. This one here, it's what tells you do not sell anything, because the price, after a strong bearish momentum, breaking all the demand zone at this level here during the New York session, where the activity is at its peak, if the price doesn't see continuation, And moving lower, and the buyers, they retrace all the way 100% of the move. Looks like that the sellers weren't able to push the price lower. But how can you create that understanding? And that's a basic understanding in trading. For some of you, maybe you say, oh my God, that's right, yeah, Theo, it's correct, oh, that's good. But in order to come to this point and understand what's going on here, just by observing the chart in 5 seconds, you need practice, and you need screening time. You need to spend some time to understand the market. But because we want to trade and we want to learn how to trade at the same time, the best combination comes on the higher time frames, even on the 4-hour chart, at least 4-hour chart, if not the daily. But trust me, after 12 years, if you ask me what would have I done the same if I was about to start trading now, what I will do the same, I will tell you I will just keep trading on the daily chart. Because if you make 5%, let's say you make 5% profit considering the losses on a monthly, on this month for example, and you manage to take 3 trades on the daily chart, only 3 trades within this month, and you make 5%, or if you make the same 5%, but you manage to take 60 trades on a lower time frames and you make the same, I believe it's okay. It's just you can see what works best for you. Okay, I'm not here to tell to anyone how to trade. I'm just here to share my experience and to give you my knowledge based on experience, not based on textbooks. Based on textbooks, I give you the analysis, but based on experience, I try to give you the shortcuts. What time frame? Someone asked, what time frame do I prefer? Look, I prefer to trade on the daily charts, to be honest, and but it depends, because at MarketMinds Mastery now we provide a lot of analysis for brokers, for hedge funds, for prop firms. So the time is a bit limited for intraday trading. Also, although that I love trading the 15 minutes, 30-minute charts, when the daily, everything according to the daily time frames. If the daily is in a nice trend or it has a nice price action, then definitely, like today, this morning, I'm looking for the euro US dollar, let's say on the 30-minute chart. Let's see what's going to happen. If this is going to end up as a bullish engulfing, guys, and it's going to close above this S1 support, it means a false breakout occurred. And the bullish divergences on the RSI with bearish lower low price action, I will definitely go for long position and I will target this area here. But if the price will just retrace a little bit and continues lowering, then definitely I will not maybe perhaps looking to do something with this one, because I want to trade from supports, I want to trade from resistance, price action. Euro, Japanese yen. If this, now we are creating all these if scenarios. So we identify that the market is in an uptrend on a daily chart. So if the price stops here and reverses, we're going to look to trade long. Otherwise, if it's continue moving lower, the next area of support is down here. Clear? Now on the 30-minute chart, if you want to monitor the price, let's see what's going to happen in the next 30 minutes, if buyers will step in or not. Okay, but this is the difference between what we explained before on the USD JPY yesterday, pretty much, I think it was at the same time, of course, at the same time. Yesterday, the sellers, they took control, and since the time they ended the bearish activity, the market moved in a very small range to the upside. And then during the Asian session early this morning, the price moved lower. This shows that the sellers are still in control. They didn't got bailed out. That's a seller's market. So most likely we expect a continuation to the downside. I said most likely because we are at an area of support and we don't know what's going to happen here, guys. Price may going to push to the upside. Okay, but understand what the market tells you. And how did we come to this conclusion? Simply, we looked at the daily chart. So even if you're not going to trade the daily chart, just keep always look at the daily chart to grab your support, resistance. It's gonna help you enormously, guys. Okay, so let's see what's gonna happen here. For me to trade to the long side, this one from the support is not enough to see a hammer. I want to see a bullish engulfing, because for me it's a stronger price action. A hammer, what is a hammer? For those, you're going to have an aha moment now. Let me explain you this. Here it's a hammer. Do you guys see this? So here it's a hammer. A hammer is nothing than a lower high and a lower low. So the price still makes lower highs and lower lows. The same with this hammer here. Price makes lower highs and lower lows. So the market is still in a downtrend. The hammer, though, when you find the hammer in an uptrend, it has bullish implications, because it shows that this seller's area is about it came to an end. Okay, but what's the difference between the hammer and the bullish engulfing? The bullish engulfing, one sec, let's find a strong bullish engulfing, a well-defined bullish engulfing. I'm pretty sure we're going to find one here. So, for example, this one here, the bullish engulfing. The bullish engulfing, guys, the difference with the hammer is that the price, it made a lower low, but it closed higher than the previous candle high. So a bullish engulfing, it doesn't show that the market is about to reverse. It shows that the opposite force, the buyers, they already took control of the market. They already pushed the price higher. So it's a stronger signal than the hammer. Okay, again, everything is based on probabilities to avoid any misunderstanding, misconfusion. Everything based on probabilities. We can find, let's say, hammers, they work, and bullish engulfing, they work. We can find hammers and bullish engulfings, they didn't work. So it's nothing for sure and guarantee all the time. But what I'm saying is that if you see a hammer here, let's say this is the end of this candle, the market still makes lower lows and lower highs. Whereas if you see an engulfing, a bullish engulfing, the market made a higher high. So there is a higher probability that this is going to push to the upside. Okay. We can talk about that in the next sessions as well, on Monday, Tuesday. Great British Pound, Japanese Yen. Again, the price is not the price didn't decline from the strong resistance. Double top reversal. We expected the price to move lower. It's been since the first touch. It's been 1, 2, 3, 4. That's the fifth day. It's been 1 week, one trading week. The price is still somewhere here. That's not how we expected the market to behave. New Zealand Canadian dollar, guys, was screaming from the beginning of the week that this is a seller's market. This is one of the clearest downtrend. I gave you the minimum target. I gave you the inside resistance. I mark it there. You see it pretty much every day on these live webinars. So the price yesterday tapped into this area of resistance, and I'm showing on the 30-minute time frame. Maybe you could have used the ATR, average true range indicator, to grasp the market move. Plenty of time to place an order here. Yesterday, all day long, even if you have looked this once, you could have placed an order here. You can go with 10, 20 pips stop loss. Price is moving lower. Now, why this is a high probability trade? Because we trade the daily chart, well-defined daily chart environment, and we trade it on the 30-minute chart. So we take the reversal point or the reversal pattern on the 30-minute chart, and we apply it in the anticipation for the market to move lower. It's in a downtrend, so the rest, New Zealand, Swiss franc, and Canadian dollar, Swissy. This one here, we said we don't really want to. I'm not looking to trade this one as a downtrend, because the market here after okay, pay attention to these guys. This one here, the market was in a downtrend. A downtrend that started from there, ended there. It lasted about 2.5 weeks, and then we see about 1.5 week retracement, and then a nice move to the downside. But the problem is that the price stayed in a correction phase more time than it stayed in the last leg to the downside. So this creates a confusion that why the correction it takes longer than the move, that the directional move, and that and that's a red flag. Okay, after the market break with one candle outside of this area, the next candle at least should have followed through and pushed the price lower, but it was like a false breakout. So after this false breakout, the market didn't go anywhere and started moving upwards. Now, it's a high probability trade to trade something on the lower time frame at this resistance, but we don't treat this market as is in a downtrend. Okay, that's the difference. Gold price, again, it started around this area of resistance here. Then we have the support at the bottom. Nothing special with the gold today. WTI finally broke above this monthly area. From this point here, guys, remember I explained we anticipate an inverse head and shoulder. This started beginning of January, And after this one here and that bullish engulfing, I showed you on the charts that the market has bullish sentiment. Now, it also depends how much time are you willing to stay in this kind of trade. If you enter the trade and you expect the breakout to occur, because we are trading in with leverage and with brokers, we pay the fees, we pay the swaps, we pay the commissions, depends on the account. So sometimes it's I'm not going to say it's not worth it, because every trade that it has a good potential, it's worth it. It's just for how long are you okay to stay within a trade and pay the fees until you go to break even and make your profits. Remember, from now on, if this is going to stay above, we need 2 days to close above this resistance now. And from now on, we will be looking to target this area here. You can use the 30-minute chart, 15-minute chart, any lower time frame, 1 hour, 4-hour chart, any lower time frame you prefer. And German 40. Maybe today we're going to see some push to the downside, because a hammer at resistance is a reversal pattern. Okay, one of the strongest reversal patterns. I'm not saying it's going to happen, because we don't know what's going to happen, but for sure the market is trading within this range. If you want to trade short, to enter short from here and to target this area for the London Open, that might going to be a good idea. If price breaks above this area here, then we might going to look for shorts, for long, sorry. All right, traders, I think that's all for me today. I would like to wish you guys to have a nice weekend, get some rest. Happy trading for those that are going to be around during the London and New York session. And here at MarketMinds Mastery, we would like to thank you for your support. We believe we add value to your trading, and we hope we are adding value every single time we do the webinars. Again, happy trading, and I will see you tomorrow. I will see you on Monday, not tomorrow, it's Saturday. On Monday at the same time. Bye, everyone.